Hey, everybody, my name's Justin Von Eigen, and my job is to help you pass your life and health insurance or health insurance exam on the first try. Today, I'm going to be covering disability income insurance. This is going to be a disability income masterclass. I'm going to be going through the state exam outlines. What I'm going to be covering here is to cover every state's outline. So this is going to apply to you whether you live in Texas or California or Florida or Maine or Texas or Oklahoma. Does not matter. So you don't need to ask me for a specific in the chat because it's this covers it all. All right. If you'd like a free study guide, just reach out to me at the email in the description of the video, and you'll see some other products that we offer there as well. So first, I'm going to go over what disability income insurance is. All right. Disability income insurance is designed to make sure that if someone becomes disabled, they can keep making money, right? If they become disabled and they can't do their job, then they can keep making income and keep making money and keep getting paid. So typically, someone has to become disabled, and the definitions of disabled vary. So the definitions for disability, for total disability, there's two definitions you're going to want to know. Okay. The first one you're going to want to know is own occupation. Own occupation. So what this means is someone disabled to the point where they can't do their own occupation, or own OCC, OWN-OCC is sometimes what it's called. Own occupation. So does the disability prevent them from doing their own occupation based on prior education, training, and experience? All right. Now, the next definition is any occupation. Any occupation means can they not perform any occupation due to prior education, training, or experience. All right. The own occupation definition is less restrictive, and this is the more desirable policy because it's easier to qualify for not being able to do your own job as it is to qualify to not be able to do any job. Let's take, for example, if someone is say a mailman, right? If they become disabled and they can't walk, right? Say they have a route that they walk. They can't do their own job because if he becomes disabled, he can't move his leg. Say someone loses mobility in their leg. Obviously, that mailman can't walk his route anymore. We're going to assume he doesn't drive, right? He walks it. But he may still be able to do any occupation. So there may be another job he can do. Like maybe he can sit in the office and work on the computer or something, right? He might have to use crutches or a wheelchair or something to get there, but he can still do it. So that's a little bit more restrictive for the insured, right? Because it's if that gentleman had a own occupation policy and he lost the ability to use his leg, he would qualify for under total disability if he had an own occupation policy. But he might not qualify for total disability under any occupation policy because they say, okay, well, you can't do your job, but you can do a job. Typically in long-term group disability insurance, for the first 2 to 5 years, it's own occupation definition. And then after that, it's going to be any occupation. So there's an own occupation definition that typically applies in long-term group disability insurance that applies for the first 2 to 5 years. And then after that, it's going to fall under the any occupation, right? So they give you some time to maybe, learn how to do another career or I don't know, whatever the case is. But that's typically how the own occupation versus any occupation works. Okay, so next we're going to be covering partial disability. So partial disability is another definition to qualify for disability. And this is typically someone can only qualify for partial disability after they've already qualified for total disability. So you have to be you have to be total before you can be partial. And partial disability is designed to incentivize someone to go back to work, right? Because their disability income insurance is not going to pay their whole wage that they had. So say someone made $100,000 a year, the disability might pay $60,000 or whatever. Say that's what they're getting for it. The partial disability will allow them to go back to work and still get some of their disability insurance, right? So what this does, it says, hey, if you can go back to work like part-time. So for instance, we'll take the mailman example. Say the mailman was going through physical therapy and his leg is okay now. His leg's better. He's feeling better. But he doesn't want to put too much strain on it. They might say, okay, well, you can go back to being a mailman for 10 hours a week or 20 hours a week or whatever. You can't do the whole 40 hours, right? Driving around and being on your feet, but you can do, 10 to 20 or whatever it is. So he can go back to work and make money. And then the partial disability will help supplement the difference there, right? He may not still, it would typically be like 50% of it depends on the how the benefit's chosen. It could be a percent of how much he's lost or a flat amount. Typically it's a flat amount and it's 50% of the total disability benefit. So if he's back to work, right, he's still going to be having a supplement, but even if he's at work part-time and then has the disability helping with some of the difference, he's still not going to make as much as if he was at work full-time. So they're saying, hey, you can go back to work and make some extra money and still have some disability insurance to help you if you need it, if you're not able to return to work full-time or perform all of the duties at the job. So for partial disability, he may receive a flat amount benefit, which is typically 50% of the full death benefit, as I said, but it's stated in the policy. Or he could receive a residual amount benefit, which is used after full disability when they're returning back to work with a reduced workload. So this is based on the proportion of income loss due to the partial disability. Okay. It's usually determined by multiplying the percentage of lost income from the stated monthly or by the stated monthly benefit for total disability. So say you lost 60% of your income from the partial disability, then that you get on the residual benefit amount, that person would get 60% of the total disability benefit, right? So residual benefit is a percentage and flat amount is just a flat amount. Okay, I hope this helps you. I wonder if maybe I'll put this in an example. So say this mailman suffered a 40% loss of income because of his partial disability. The residual benefit would pay 40% of the total disability benefit. Okay, so think about it. If he's getting 60% of his normal wage and then 40% of the disability benefit, he's still getting less than his full normal wage because that 40% of the disability benefit is only, 60, 70, 80% or whatever of his full income. So if he's getting a portion of the full disability benefit, it's still not going to be as much as if he finally went back to work. So it incentivizes people to get back to work and not just mooch off disability because they, in companies, insurance companies and employment companies, regular corporations, they don't want to, they don't want people stuck on disability forever. I mean, that's a terrible existence, right? So next up here on the exam outline is permanent disability. Also, if you'd like a copy of your state's exam outline, just email me at jve@the.com. So permanent disability is one that pretty much will prevent them from returning to work for the rest of their life without any expectation of recovery. So, it's like if you broke your neck and you can't move your limbs, like, yeah, you're going to be in that situation for the rest of your life. Next is presumptive disability. So there's a presumptive definition in disability insurance. And this states that if an event is catastrophic enough that you are just presumed to be totally disabled. So example, if someone gets shot in the head, right? And then they survive, but they lose mobility in 2 or more limbs because of how catastrophic that is to someone, they're just presumed to be permanently disabled and totally and permanently disabled. Another one is if they lose their vision. What if they lose their ability to speak, if they can't hear anymore, and then loss, like I said, in 2 or more limbs is typically considered presumptive disability. Okay, that's presumptive disability. So next is recurrent disability. So a lot of times if someone becomes injured, the disability they'll recover and then it can happen again. So we'll take into account the mailman that we've been talking about, right? This is recurrent disability. So the mailman, say we have Mr. Mailman, and his leg's feeling better, right? He's back. He's got some pep in his step again. He's throwing those letters in the mailboxes, and letter in the mailbox. And but he's walking, and he thinks he's as strong as he was before. He goes to lift up a heavy package, and boom, he hurts his leg again because it's not as strong as it was. It's like it's weakened, and he re-stimulates the injury, and it happens again. So sometimes there can be recurrent disabilities. Now, the definition of recurrent varies from policy to policy, but typically they have to have that recurrence happen within a certain amount of time for them to not have to experience an elimination period. So elimination period is like a time deductible for disability insurance, where the insured has to wait a certain amount of time of being disabled before the benefits kick in. We'll cover that in a little bit, but essentially with the recurrent disability provision, this means that if someone, say it's, could be 30 days or 60 days or 90 days or something like that, but say someone's disability happens within that time, they would not have to go through another elimination period. But if it happens after that time, then they would. So we'll take the mailman. Say the recurrent disability provision on his policy says that if the recurrent injury or disability happens within 90 days of returning back of your recovery, then the policy will kick back in force without an elimination period. That guy, I was just talking about how he hurt his leg, right? Say he hurt his leg. Mailman goes back to work after hurting his leg. He's back full time, and it's within the recurrent disability provision says that the recurrence has to happen within 90 days. 2 weeks in, hurts his leg again. Okay, he can start receiving benefits again without having to go through an elimination period. But if it's a 90-day recurrent disability provision period, then and it happens in day 91, the recurrence, then he has to go through a whole new elimination period again. Now, residual disability is very similar to partial disability, where it provides benefits based on the percentage of income lost due to disability. So partial disability is compensated for the portion of income lost due to the inability to perform your job. And residual disability typically focuses more, though, on the income loss rather than just not being able to perform your job's duties. So it's very similar, but essentially it's if you experience if you experience a 30% income reduction due to reduced work capacity, residual benefits will pay a percentage of that. And disability, whether it's permanent in own occupation or any occupation or partial or residual or whatever, is based on someone's inability to perform the duties of a job, right? So their inability to perform the basic duties on a job. Some clarification here, on partial versus residual disability. A partial disability plan will pay a fixed percentage of the total disability benefit regardless of the actual income loss. So sorry about that. I get confused sometimes. There's so many words thrown around. But partial disability will pay a fixed percentage regardless of what the income loss is when someone returns back to work. All right. On a part-time basis. Residual disability insurance will pay a portion of, it pays back a percentage based on how much the percentage of income that's been lost. So with a partial disability plan, for example, if the total disability benefit is $4,000 per month, the partial disability benefit would be $2,000 a month, regardless of how much income you lose. Okay. But with a residual benefit, if you had a 40% loss in income and your total disability benefit was $4,000 per month, you'd receive 40% of the $40,000, which would be $1,600 per month. Okay. So the difference is partial disability pays a fixed percentage regardless of the income lost, and residual pays a variable benefit based on the actual percentage of income lost. All right. So residual pays a percentage, partial pays residual pays a varying percentage, a partial pays a fixed amount, a fixed percentage. All right, so I hope this is helping you learn about disability income insurance to help you pass your life and health or health insurance exam on the first try. If you'd like a free study guide, just reach out to me at the email in the description of the video. You can also check out the other products that we offer. Now, next thing I'm going to cover is own occupation versus any occupation. I may have already covered this. I don't know. I've made like a million videos the last few days. So hopefully, if I cover it again, then whatever, you can learn it again. So total disability. Oh, I did cover own occupation, any occupation. My bad. So own occupation is if you are disabled to the point where you can't perform the duties of your own occupation. And total disability is if you, or any occupation definition of total disability is if you can't perform the duties of any job or occupation at all. Okay, so next we're going to be covering what a basic total disability plan is in disability income insurance. This is something that's on the pre-license exam outline. So a basic total disability plan is just a straightforward approach to replacing someone's income if they're disabled, focusing on total disability without any of the additional bells and whistles that I talked about previously. Now, total disability, the definition, as I've talked about before, could apply to either own occupation or own OC definition, where they're disabled if they can't perform the substantial immaterial duties of their own occupation. This allows benefits even if the insured can work in another job. And the any occupation or any OC definition is considered disabled if they can't perform the duties of any occupation for which they are reasonably suited by education, training, or experience. So this is more restrictive. It requires a higher level of disability to qualify for those benefits. Now, a basic plan may use either definition, but the any occupation definition is more common due to its affordability. So next, with a basic total disability plan, we're going to talk about the income replacement benefit. So there's a monthly benefit amount that's paid out in disability policies, a monthly benefit. And this provides a predetermined monthly income, usually 50 to 70% of the insured's pre-disability earnings. This helps cover living expenses during the period of total disability. So if they're totally disabled, this helps cover their living expenses. Now, in a basic total disability policy, there is an elimination period or a waiting period. And this is a specified period of time, typically 30, 60, 90, or even up to 180 days, that must pass after a disability occurs before benefits begin. So this is so that someone can say, well, I hurt my foot, I can't work this week, and qualify for disability. So you have to be disabled for like a good amount of time before the policy will kick in. All right. This acts as almost as a deductible, but with time. So some other insurance policies have a deductible you have to pay with cash, right? So you have to pay a certain amount of money before the insurance will kick in. So say the deductible is $5,000. You're responsible for the first $5,000 of costs, and then after that, the insurance kicks in. This is with time. With disability income insurance, it's a time deductible. So typically, the longer the elimination period, the longer the waiting period, the lower the premiums. So a policy with an elimination period of 90 days will be cheaper than a policy with an elimination period of 30 days, assuming all other things are equal. Okay. So there's also a benefit period. The benefit period is the maximum length of time that benefits will be paid for a continuous disability. So the benefit period is how long someone will receive benefits for. So if say it's 5 years, well, you're going to receive disability benefits for 5 years from this coverage. Now, short-term disability provides benefits for a limited period. Okay, a short-term disability policy will typically cover 2 to 5 years, but a long-term disability policy will cover benefits until a specified age 65 or life. So it's usually up until age 65 or life. 65 is because people will usually start collecting Social Security by that time. Now, the longer the benefit period, the more expensive the policy is. If this is something through an employer, a lot of group disability plans will have they'll have short-term and long-term disability in the benefits package. So sometimes people may have to pay extra for it, but there'll be long-term and short-term, meaning, hey, there's a short-term disability that will cover you in the shorter term, and then long-term that covers you in the longer term. So in a basic total disability plan, there's no partial or residual disability coverage. So benefits are only payable when you meet the definition of total disability. So in a basic total disability income insurance plan, there's no partial or residual coverage. This is something that has to be added, or it's a more comprehensive plan. So benefits would only be payable if they meet the policy's definition of total disability, which we've talked about several times. On a basic total disability policy, there's usually no additional riders, which we're going to get into riders in a minute here. That's next up. And because there aren't so many extra features, the basic plans are usually more affordable. All right. So in terms of a comparison with a comprehensive disability plan, the basic total disability plan will only cover total disability. A comprehensive plan will cover total, partial, and residual disability or residual disability. In a basic plan, the benefit is fixed, whereas in a comprehensive plan, the benefit can be adjusted with riders. All right. A basic plan is typically cheaper. It's a lower premium. There are no riders, and it's ideal for people who need basic protection. And a comprehensive plan is ideal for people who will pay a little more to have exclusive, extensive protection. I'm going to share my screen here just to show a chart that's a comparison of basic total disability and comprehensive plans. And you guys can take a moment here to pause the video if you'd like, take a screenshot of this or whatever. This might help you. Okay. Couple things I'm going to recap that are important to understand. The elimination period is the waiting time before benefits begin after a disability occurs. Okay. The benefit period is the maximum time that benefits are payable during a disability. You have to understand the own occupation versus any occupation definitions. Okay. So it's very important to understand these terms and components for your pre-license exam. Please subscribe to the channel, turn on post notifications if you feel like this is going to help you. You want to check out my other videos too. You can pass your exam pretty much just by watching the content on my channel. If you'd be interested in potentially selling life insurance with me, I have an agency. We provide our agents 100% of the clientele. So you work at home over the phone. Don't go to people's houses. We provide you all the leads that you need. If you'd like more information on that, you can just reach out to me at the email in the description, and also check out the products that I have available in the description of the video. Okay, I'm going to cover some riders here for disability income insurance policies. First one I'm going to cover is the cost of living adjustment rider, COLA, like Coca-Cola, COLA. So this is an optional rider that you can add to some disability income insurance policies that will help protect the purchasing power of the disability benefit. So this helps protect against inflation. So as inflation increases prices of everything in life, electric, eggs, milk, gas, whatever, the same, like your income benefit won't have the same impact 10 years from now as it does today because of rising prices. So the cost of living adjustment rider will make sure that your disability income benefit can increase over time to match the consumer pricing index, or CPI, which is the inflation calculator. So if inflation increases 3%, then you'll get a 3% boost on your disability income insurance benefit if you had the cost of living adjustment rider. Now, some cost of living adjustment riders will offer a fixed percentage increase, which would be a predetermined annual increase, like 2% or 3% or 5%. And your benefit amount will increase by that fixed percent every year. Whereas if it works on the consumer pricing index adjustment method, it will increase by the percentage of the consumer pricing index's inflation for that year. Now, there are also compound versus simple interest. So compound interest adjustments where increases are applied to the current benefit amount, including previous increases. Okay. This leads to a larger benefit over time due to a compounding effect. Whereas there could be simple interest adjustments where increases are applied only to the original benefit amount. Now, this is where the benefit will grow at a steady rate without compounding, resulting in smaller total increases. So, for instance, say there was a 3% increase. Say you made $1,000 a month in a benefit, and there's a 3% increase in your policy year over year for your cost of living adjustment. Your new benefit would be $1,030 per month because that's 3% of 1,030. Now, the next year, if there's when the adjustment's made, if it uses the compound interest adjustment, it's going to go 3% of 1,030, which is going to add 3% of 1,030, the new benefit, right? If it's the simple interest adjustment, it's just going to add 3% of the 1,000, the original benefit amount, to your thing. So it'll be 1,060, the new benefit, because it's going to add another 30. Whereas if it uses the compound interest adjustment, it'll be a little bit more than 1,060 because you're going to be taking 3% of a bigger benefit amount. So it just helps compound over time. Now, this rider typically activates after benefits begin, and adjustments are not made. There's no adjustments during the elimination period. Okay. Now, the cost of living adjustment rider will result in a higher premium for the policy, right? Because it's a risk that the insurance company is going to have to pay out more over time on this policy. So it does increase the value of the premium. The cost of living adjustment rider will help you maintain purchasing power so that you don't have to worry about not being able to afford the same amount of stuff year to year as prices increase. And it really gives someone financial security and peace of mind over time. All right, the next rider we're going to cover here, is the future increase option rider. So the future increase option rider, also known as the guaranteed insurability option, GIO, or the guaranteed purchase option, GPO, is something that can be added on to an individual disability income insurance policy. This allows the policyholder to increase their coverage amount in the future without proving evidence of insurability. So they don't have to go through underwriting again. This means that you can obtain additional coverage as your income grows, regardless of changes in your health status. So some key features of this rider: you have guaranteed right to increase coverage. So you have a guaranteed right to increase your coverage, and there's no medical underwriting required. So you can increase your policy's benefit amount without undergoing additional medical exams or answering health questions. Even if your health declines after purchasing the policy, you have the right to increase your coverage amount. All right. Now, the option dates for the future increase option or guaranteed insurability option are either in specified time frames or life events. So this rider, it'll outline specified specific dates or age milestones, like annually, every 2 years, or at certain ages when you can use this option. And also, or some policies allow increases at significant life events like marriage or birth of a child, or if you have a significant salary increase. So those are two events that can result in exercising and using this rider. Now, there are maximum increase limits, so you can't just increase it to whatever you want. There's a maximum amount that you can increase your benefit every time you use this option. And there's also a maximum total benefit that you can reach through the rider. This is usually determined when you first get the policy. So you can't just increase a certain amount forever. There's usually a total maximum benefit that you can increase to. So for qualification for this, you usually have to demonstrate that your income justifies the increased benefit, right? If a lot of times you'll have to justify that your income, or show that your income went up. Insurers will typically limit the total disability benefit to a percentage of your current income to prevent overinsurance, right? And the premiums are based on your attained age. So the premiums will increase on the policy. The premium for the additional coverage is calculated based on your age at the time that you use the option. Okay. Now, since health status isn't assessed, the health rating from the original policy usually applies generally. So with the guaranteed insurability option or future increase option rider, there will be an increase in premium both when you add the rider And then every time you use the rider to increase the benefit amount, your premium will increase as well. So it costs you both more to have the rider, and then every time you use the rider, it's going to cost more. Now, if you miss an option date, or you don't use the option within the allowed time frame, you might forfeit the opportunity. So say you have a child, and that's one of the events spelled out in the rider where you can increase your coverage amount. If you wait too long, you might lose the opportunity to use that rider. Okay, so next we're going to be covering the change of occupation provision in individual disability income insurance. So the change of occupation provision, this outlines how the insurance company will adjust the benefits and or premiums if the insured changes occupations to a job that's less hazardous or more hazardous. Obviously, this affects the risk assessment and the financial aspects of the policy, because if someone goes to a job that's riskier, then the disability insurance company has to evaluate, hey, how much higher of a chance do they have that they will be disabled from this job? So the purpose of this is because insurance companies will categorize occupations based on the level of risk that's associated with them. So jobs that are more hazardous have a higher likelihood of disability claims, right? Like if someone's a skydiving instructor, or like, I don't know, what's some crazy dangerous, like a roofer, right? If someone's a roofer, they have a higher chance, which usually that'll be covered under workers' comp insurance, but still. And also it ensures that the premiums and benefits are appropriate for the level of risk associated with the insured's current occupation. So this is how it works a lot of times. So say someone changes to a more hazardous occupation. If the insured changes, if this person changes their job to a more hazardous occupation without notifying the insurer and then files a claim, they might reduce the benefits to reflect what the premium would have purchased for the more hazardous occupation, right? Because before, say they're doing something super simple, like they're watching TV. Say they're getting paid to watch TV. And then they start doing something like being a roofer, or something that's, they're putting their body a lot of risk every day. Obviously, for the same amount of disability insurance, it's going to cost more money if someone has a higher risk of getting hurt because of what they do for work. So they may increase the premium. If the insurance company is notified, they might increase the premium if the job is more risky. If it's less risky, they might lower the premium. But if the insured doesn't notify the company and then there's a claim filed, then the insurance company might pay less if it's a more hazardous job that they switch to. It might pay more if it's a less hazardous job that they switch to. So the person with the insurance, the insured, they're usually obligated to notify the insurer in the policy's terms and conditions of any changes in their occupation. And that's outlined in the language of the policy. And the policy will specify how benefits or premiums are adjusted, often based on the insurance company's occupational classification and premium rates. Here's an example of a formula that would be used for changing the rate. So they'll take the adjusted benefit will equal the premium paid divided by the premium rate for the new occupation times the original benefit, right? So it's essentially like a percentage of it. So if they say that this job is 20% more risky, then they're going to have to pay 20% more. It's essentially like what it boils down to. You're not going to have to do any math, I don't think, not too much heavy math for your life and health insurance exam. So, but yeah, that's basically how the adjustment formula works. And its impact on claims with claims processing. So when the claim is filed, the insurance company may verify the insured's occupation, right? So they're going to say, okay, you said you were a cotton candy maker. We're going to check. You still cotton candy maker? Oh no, you play with sea urchins for fun. Now, so there may be a change of occupation there, and it would adjust. The thing is, though, the insurance company can't deny a claim solely due to a change in occupation. All right? It only permits adjustments to the benefits or premiums to align with the new risk level. So if someone changes jobs, the insurance company can't just change it, right? So there's some examples here. Example 1, change to a more hazardous occupation. And I'm going to put this on a Google Doc right here so that you guys can see. But we're going to look, change to a more dangerous occupation, and then change to a less hazardous occupation. So we're going to check this here. And I'm just going to share my screen. Doo-doo. Okay. There I am, back. Okay. So change to a more hazardous occupation. The original occupation is an office manager, low risk. New occupation, construction worker, high risk. We're going to blow this up for everybody on their phone. Scenario, the insured switches jobs to become a construction worker without informing the insurer. After a year, the insured becomes disabled due to a work-related injury and files a claim. Benefit reduction. The insurer adjusts the disability benefit downward to reflect what the original premiums would have purchased for the higher risk occupation. If the premium paid would have bought $2,000 monthly benefit for a construction worker instead of a $3,000 benefit for an office manager, the insurer will pay $2,000 per month. And then essentially this just outlines the opposite happening for a less hazardous occupation. This is where if they adjust the premiums. So they switch from an electrician to a teacher, obviously lower risk as a teacher, and the insured notifies the insurance company of the change, and the insurance company adjusts the policy. And with the premium reduction, the insurer reduces future premium payments to reflect the lower risk. And there'll be a refund. The insured may receive a refund of excess premiums paid since the occupation change. Okay. Okay, a couple tips for your exam. You're going to want to know what the change of occupation provision is, how it's a clause that allows the insurance company to adjust benefits or premiums if the insured changes occupations. You're going to want to expect some scenario questions. So expect questions that present a scenario where the insured changes occupations and you must determine how the benefits or premiums are adjusted. Remember that the person with the insurance, the insured, is typically required to notify the insurer of occupation changes. And understand that hiding occupation changes could lead to reduced benefits, but insurers must act within policy terms, so they can't just cancel it. Okay, so in addition to the monthly income benefit that the insured will receive, there are also other cash benefits that you'll need to know about to pass your life and health insurance or health insurance exam. So other cash benefits, these refer to additional financial benefits provided by the policy beyond the basic monthly income replacement. So these are designed to add extra financial support in specific circumstances related to disability, injury, or recovery. All right. First one I'm going to go over is the accidental death and dismemberment, AD&D benefit. So some disability policies might have an accidental death and dismemberment benefit where a lump sum payment will be provided if the insured dies from an accident or suffers specific injuries like dismemberment due to an accident, like loses a limb or something like that. This usually includes loss of life, loss of limbs, sight, loss of speech, loss of hearing. And this is typically a multiple of the monthly disability benefit. So like, for example, if the insured loses a limb in an accident, they receive a lump sum payment to cover additional expenses. So usually it's just a lump sum payment that they would receive as a multiple of the disability benefit, or it's a specified amount. Now, some policies will also have a rehabilitation benefit. What this will do is offer additional funds to cover the cost of rehabilitation programs to help the insured return to work. So imagine they get hurt and they injure themselves and they're disabled. There may be a real rehabilitation benefit that will pay to help get them back into working condition. This encourages people to participate in new job training or go to physical therapy, and it might cover all or part of the rehabilitation expenses. So one example could be not only is it physical rehabilitation, but it could be work rehab too, right? So the policy may pay for a vocational course or like a course that will train them for a new job suited to their abilities after their disability happened, their more restricted abilities. Next is a medical reimbursement benefit, which is not for a non-disabling injury. So medical reimbursement benefit for non-disabling injury. Now, this provides reimbursement for medical expenses resulting from an injury that does not cause total disability. So this will pay for treatments like emergency room visits, minor surgeries, or physical therapy. And this is typically pays a percentage of the monthly disability benefit or a fixed amount. So an example would be the insured injures their hand but can still work. The policy would reimburse for the medical costs of treating the injury. So it's like, hey, you got hurt, not so hurt you can't work, but you still have to pay to get it treated. So we're going to help you with a piece of that. That's what the medical reimbursement benefit or non-disabling injury benefit does. Some plans, I believe, call it an indemnity benefit. Let me check here. Oh no, non-disabling injury. My bad. And oh yeah, so it's it's called an elective indemnity benefit as well. It could be called elective indemnity, where the insured may sometimes use this option. They could use it sometimes when applying for the policy. Some of them have a hospital confinement benefit as well. So the hospital confinement benefit offers additional cash benefits when the insured is hospitalized due to a covered illness or injury. This is usually a daily payment for each day of the hospitalization. Okay. And it helps cover extra expenses like hospital bills, deductibles, or personal costs during confinement. An example could be that the insured will receive $100 per day during a 5-day hospital stay, totaling $500. So this is additional cash when they're hospitalized due to a covered illness or injury. There might be a waiver of premium benefit as well. So what this does is it waives the premium payments during periods of total disability after a specified waiting period. So it's saying, hey, if you're totally disabled, after a certain amount of time of being disabled, you no longer have to make premiums on the policy. And this eases the financial burden by eliminating the need to pay premiums while their income is reduced. And it generally activates after they've been disabled for a certain period of time, such as 90 days. And we'll use that as an example. So after 90 days of disability, the person insured no longer has to pay premiums, but the policy will remain in force. Right. One other benefit is a transplant benefit. This considers them to be totally disabled if they become disabled as the result of donating an organ. Okay, so this provides disability benefits during recovery from a transplant surgery. Now, one could be, hey, if they donate a kidney and they're unable to work during recovery, the policy will pay the benefits as if they were disabled due to an illness. So that's a transplant benefit. If you hook someone up with a kidney, your policy might help you out. Next is a survivor benefit. So this will pay a lump sum benefit to the insured's beneficiary if the insured dies while receiving benefits. So survivor benefit says, hey, if John is receiving benefits and he passes, he named his wife as beneficiary, she will receive a lump sum amount. And it's often a multiple of the monthly disability benefit, like 3 times the amount. This is to provide financial support to dependents after the insured dies. The next one I'm going to cover is the return of premium rider. This will refund a portion of the premiums paid if certain conditions are met, usually if no claims are paid over a specified period of time. So, for example, say in a policy after 10 years, if it had the return of premium rider, after 10 years without filing a claim, the person who paid on the policy, the insured, could receive a refund of 70% of the premiums paid during that period. There may also be a cash value benefit or a cash surrender value. This could be in the policy. It could build a cash value over time, which they can receive if they cancel the policy. So it's almost like a savings component, which will provide a lump sum around policy surrender. You may or may not have this on your exam, but it's not common in all policies. It's usually a lot more expensive. So this may not even be on your exam at all. So the return of premium provision, the return of premium rider that I just covered, and the cash surrender value rider. Those are 2 additional cash benefit options that essentially allow what would be considered a refund, right? Because the cash surrender value, you get the cash value if you cancel. And then the return of premium, you get a percentage of the premium. So if anything asks on your exam about the return about refunds on disability insurance, it usually has to do with your cash cash value rider if the policy has cash value, or a return of premium rider. But those drastically impact the premiums of a disability income insurance policy. Okay, so next I'm going to cover exclusions in individual disability income insurance policies. Exclusions are specific conditions or circumstances in the policy that the insurance company will not pay benefits for. All right. So the first one is pre-existing conditions. These are medical conditions or illnesses that the insured had before the effective date of their policy. All right. So there are a couple important terms here. The exclusion period. The policies may exclude coverage for disabilities resulting from pre-existing conditions for a specified period, so like 12 or 24 months. So if you have a disability from a pre-existing condition, it may not be covered for a certain time, right? Because it's going to say, hey, you either had that or you had the likelihood to get that disability or injury or illness before you even started with us. And there could be a permanent exclusion. So some conditions may be permanently excluded from coverage. So an example is if the insured has diabetes before obtaining a policy, any disability resulting from diabetes may not be covered during the exclusion period, or it could be a permanent exclusion. Also, intended self-inflicted injuries. So these are disabilities that arise from injuries that the insured intentionally caused to themselves. And no benefits are eligible on this. So the insurance company won't pay benefits for disabilities resulting from self-inflicted harm. So if you're like, hey, I'm going to cut my leg off, then they're not going to pay. All right. Another exclusion in a lot of policies is war and military service. So these are disabilities resulting from acts of war, declared or undeclared war, or from active military duty. Disabilities caused by war-related activities are generally excluded. So say someone is in the military and a bomb, blows up and they lose one of their legs, then this would result in them not receiving benefits under a civilian policy. But that's why the military has disabled policies, right? You hear like disabled vets. That's a thing. And then that's a totally different type of policy I'm not going to get into right now. Also, if you participate in federally or in a felony or illegal occupation, so if you're committing a felony or engaging in illegal activities and you get hurt, then it won't cover disabilities from that. So say someone's robbing a bank and then they have a individual disability income policy, and while they're robbing the bank, they get shot in the leg by the police officer who goes to the scene. If they can't walk well anymore, then if they're disabled from that, the policy won't cover it because it was an illegal activity. There could be mental and nervous disorder exclusions, which are disabilities due to mental health conditions such as depression, anxiety, or stress-related disorders. Some policies limit the benefit period for mental health and nervous disorders. So benefits might be payable for like a maximum of 24 months, or they might exclude them altogether. So this is saying like if someone says they're depressed, then they may only receive benefits for 24 months, even if the disability continues, or they may not receive it at all. This is how can you really tell if someone's depressed, right? Like someone could pretend if they are, if to fake, it's like if you can't fake that you lost your leg, so for a disability, you can't fake that, you're paralyzed. You could, but it'd be really, really hard, right? They can do tests and stuff like that. And there are tests for depression too, but they make sure that people aren't going to, like just say that, because you could just be like, oh, I have really bad anxiety and I can't go out in public, and you just stay at home all day and there's no way for them to tell one way or the other. Another is alcohol and drug abuse exclusion. So these are disabilities related from substance abuse like alcoholism or drug addiction. These might be excluded or limited for disabilities. The benefits might be excluded or limited for disabilities like this. So say the person's a chronic alcoholic and they get liver disease, the policy might not pay the benefits. Another exclusion could be is often normal pregnancy and childbirth. So disabilities due to normal pregnancy and childbirth or related medical conditions. Okay. Standard policies often exclude normal pregnancy and childbirth. Okay. Disabilities resulting from complications of pregnancy might be covered. Coverage can sometimes be added through a rider for additional premium. So if the insured person is unable to work due to a normal pregnancy, they wouldn't receive benefits unless they have special coverage. So it's like, say everything's fine, there's no complications, they can't take off extra time they can take off extra time, but they can't receive disability benefits from a disability income insurance policy for a normal pregnancy. Also, acts of terrorism is an exclusion. Aviation activities. So unless they're a fare paying passenger on like a major airline, if you're like driving a plane or skydiving and you become disabled from an injury from that, that's usually excluded. Also, hazardous hobbies or sports are often excluded. So if you're, like I said, skydiving or maybe scuba diving or motor racing, or you race motorcycles or something like that. So a lot of times these activities might be excluded due to higher risk. All right, coverage might be added for specific activities through a rider. And this is another thing I want to cover too. There's any means. Next thing I'll cover, and then I'll cover this. So there's often there's foreign travel or residence exclusions, meaning that disabilities that occur while traveling or residing in certain foreign countries might not be covered. All right, because of the risk of living in that country as opposed to the country where they got the policy. So I'm going to go over accidental means versus accidental bodily injury provisions. Okay. So the accidental means provision means that the cause of the accident that resulted in the injury or disability must be unexpected and accidental. So an accidental means, this means that if the injury itself, if the person, then this applies here, right? Like hazardous hobbies or sports, this is just an expanded definition of it, potentially. So like if you're doing something super risky, and if your disability insurance policy is based on an accidental means provision, it means that both the what caused the accident and the result of the accident must both be an accident, or what caused the injury, that must be an accident. So it means you weren't engaging in something that you knew was extremely risky. So if you're racing a car, right, and you get disabled, then that under the accidental means provision, you might not qualify for that claim because you were doing something that you knew was very risky. Whereas the accidental bodily injury provision or results provision will require that the result has to be unexpected and accidental. So it's not like you're like, okay, I'm going to land and break my leg on purpose. Like, no, it's like you were doing something risky, but you didn't plan on actually being hurt. Okay, so that's accidental means versus accidental bodily injury. Okay, next I'm going to cover the probationary period. All right, so the probationary period in individual disability income insurance. This is a specific time frame that begins when your policy becomes effective, during which benefits for disabilities caused by sickness or illness are not payable. Disabilities, though, resulting from accidents are typically covered immediately after the policy's effective date. So this is just a probationary period for disabilities from sicknesses or illnesses. This is to make sure that someone isn't applying when they feel like something's something's going on with them. It usually lasts for 15 to 30 days from the policy's effective date, and applies at the start of the policy, and that's it. So typically no benefits will be paid for disabilities caused by sickness or illness during the probationary period. Disabilities resulting from accidents will be covered immediately. Now, this is there to prevent adverse selection because it helps insurance companies avoid covering individuals who purchase insurance knowing that they are already sick or they're about to become sick. And it reduces fraudulent claims. So it prevents people from filing claims for pre-existing conditions right after they get coverage. Because people who are going to be sick or not able to work are the ones who would want disability insurance the most, right? You might want to understand the difference between probationary period and the elimination period. So the probationary period occurs at the beginning of the policy immediately after it becomes effective, and it affects sickness-related disabilities. They are not covered during this period, and it's typically 15 to 30 days, and it helps prevent immediate claims for pre-existing illnesses. The elimination period is the waiting period. So this applies after a disability occurs, It's the time you must wait before benefits begin. So this applies to both accident and sickness related disabilities. And it's common it's usually 30, 60, 90, or 180 days, or sometimes longer before the benefits will kick in. So it's like a deductible, but in time, which helps to reduce premiums by eliminating short-term claims. All right. So to make sure that someone, hey, they have to be disabled for a little while before their benefits will actually kick in. So next, I'm going to cover benefit limits for individual disability income insurance. If you'd like more information or any of my study guides, if this has helped you, just email me at the description in the video, and check out the other products that we have in there too. So understanding benefit limits is crucial when studying individual disability income insurance. Benefit limits refer to the maximum amount and duration that the insurance company will pay to a policyholder in the event of a disability. These are established to prevent overinsurance and make sure that they provide appropriate income without disincentivizing someone to return to work. So they want to be able to provide someone enough money without giving them so much that they just never want to go back to work. So the maximum monthly benefit amount is the highest amount of money that the insured can receive per month from their disability income policy. It's typically set to be a percentage of their income. So it's typically set at 60% to 70% of their pre-disability gross income. Okay. Some insurers will have specific maximum benefit amounts regardless of the income. So they might have a cap at $10,000 per month. Okay. The purpose is to provide sufficient income to cover living expenses without exceeding pre-disability earnings, to make sure they don't receive more money when they're disabled than when they were working. The benefit period is the maximum length of time that benefits will be paid for continuous disability. So short-term disability is typically 6 months for upwards of 2 years, sometimes 5, but typically it's 6 months to 2 years. Long-term disability can last anywhere from 2 years, 5 years, 10 years, to age 65, or even for life. Okay. Policyholders can select a benefit period when purchasing their policy, and longer benefit periods result in higher premiums. Okay. There's also the elimination period, which we've covered. Okay. And it could also integrate with other benefits. So coordination of disability benefits with other sources of income, like Social Security disability insurance, SSDI, or workers' comp, is there to avoid overlapping benefits. So this ensures that the total income does not exceed a certain percentage of their pre-disability earnings. So this is to make sure that, it takes other things into account. Some policies will include Social Security riders or Social Security provisions to provide for the payment of additional income when they're eligible for Social Security benefits, but those benefits have not yet begun or have been denied, or they begin at an amount less than the benefit on the rider. And sometimes in the integration with other benefits, say the insured receives $1,000 from their Social Security disability insurance, the insurance company from their disability insurance might reduce the benefit by that amount. So say someone's getting $3,000 from their disability income policy, and then SSDI kicks in and they receive $1,000 from that. The disability insurance company might pay $2,000, and the SSDI covers the difference. Some disability policies have a delayed disability provision. This means that total disability will not occur. This happens when total disability does not occur immediately after an accident, but develop some days or weeks later. So most policies will allow a certain amount of time during which total disability may result from an accident, and the insured will still be eligible for benefits. So this might be 30, 60, or 90 days after the accident. So it might not, the disability might not happen right away. Right. So it could be like over time, it just gets worse and worse and worse. And then all of a sudden, boom, they are disabled. So there might be some provisions in there. All right. That brings us to just about an hour on here. I hope that this helped you. I have other videos on disability insurance that I'm making or are already made. By the time you watch this, they might be already made. It'll be on the individual disability insurance underwriting. It'll be on group disability income insurance, like short-term group, long-term group, stuff like that. Business disability insurance, like key employee disability income, disability buy-sell policies, and business overhead expense policies, and then Social Security disability like SSDI. I'll have videos on that. So if you want to check out the other videos on my channel, please do. You want to watch this next video that's going to be coming up here at the end of this to help you pass your exam on the first try. Email me if you'd like a copy of my study guides or you'd like to check out the other products that we have. You can check the description of the video. I'm also hiring full-time life insurance agents. So if any of you guys are getting your life license as well as your life and health, or your life and health, then and not just your health. And you can always get the life in addition to it, but I'm hiring full-time agents. So if I helped you learn this stuff, I can definitely help you learn sales, and I can help you have a successful career. I provide agents with all the leads, all the clientele, the prospects, everything that they need to know to everything they need to succeed. Computer programs, full training. We jump on your calls and help you close your sales. We do it all. We have a full service agency, and we have the best agency in the country for selling life insurance for new agents. So if you want to reach out, like I said, in the email in the description of the video, and I'd be more than happy to answer any questions you guys have. Thank you so much.